And we are live. Good morning, everybody. It's your favorite truck driver in the whole wide world, ex-truck driver. It's Bitcoin Ben, trying to get his screens all lined up here prior to getting going here. Now, this episode is going to be very, very unique. Everyone watching over on Rumble, give me a thumbs up and a like and a share and a double extra share and a share on the side. Those of you watching on YouTube, do the same. What's up with my hat? My hat's like fading. There we go. Okay, now, hang on one second. I want to find this tweet real quick. Well, here, hell with it. It basically says what I said last week on one of my shows, that the insiders of cryptocurrencies, and we're talking those in the knows, those people are calling for $100,000 to $250,000 per Bitcoin as the ETFs are approved. All right, this is not Bitcoin Ben just saying it. This is hang on a second. All right. This is like the people that no, hang on one second. Let's get this guy on here real quick. All right. I'm gonna bring you guys video evidence that the ETFs will get approved, and that the World Economic Forum is in absolute panic mode. And I mean, wait till we watch this video of the interviews of the Bank of England, the ECB, Jerome Powell, and the Bank of Japan. All four of those people got interviewed, and they got crushed by somehow an honest moderator was brought in, and she absolutely destroyed these people. I mean, she destroyed them. I was sitting there watching this thing, and I'm going, how the hell is this woman not dead? How has she not been Clintoned yet? Now, those of you on YouTube, you have a special today, because I won't be moving off of YouTube today because of a special guest in an hour. Those of you who may know, here we go. All right, I'm going to share a screen. Hang on one second. Share a screen. Share screen. All right, the entire screen. Share system audio. share. There we go. Okay. Let me put me down here. All right, I'm going to turn this down a little bit. Let me make sure that my sound's right. Yep, there we go. Now, hang on a second. Here we go. Ready, set, go.
SEC chairman. Should we start? We were talking off camera about I am accused of negligence at home a lot, and I don't try it. I'm just not always smart enough to know what I should be doing, right? Is that, I mean, there's a rule now being proposed for the SEC. It's not, doesn't have to be gross negligence. It's almost anything could be construed as negligence in terms of lawsuits.
Yeah, look, I think a mandatory negligence standard in the context of investing, which is inherently uncertain. It's about the future. We can't predict the future.
And if you're going for high returns, isn't there's going to be losses from time to time that might not be from negligence?
And a legal standard like strict liability, negligence, gross negligence, recklessness, those standards are judged with hindsight. And so you have a negligence standard with something that's forward-looking. It doesn't make a lot of sense. It also, from what I would say is not just from a substantive point of view, but from a legal point of view, imposing contract terms on private parties, that's a pretty big step. You know, parties who can freely negotiate. What I think is a better way to approach the investor and the manager is ensuring alignment of interest. What are we doing to ensure that there's alignment of interest, that people have the same sort of skin in the game? That's a much better way to deal with these issues. Yeah,
don't hold your breath. That's not going to happen anytime soon. And either party, depending on who's in office, could certainly accuse the other party when they're in office of gross negligence. You don't think Republicans are talking about what's happening now as gross negligence in the economy?
I think that's exactly the point, Joe, which is that in how you manage an investment, how you manage the economy, when there are so many factors at play, with hindsight, you're always going to be viewed as not having done the best job you could.
Have you watched with interest as blue chip firms have decided that they want to get involved with Bitcoin or crypto?
Well, give me a minute. It's a fascinating etymology. Let's go back to like 2015, 16. This is an offshore retail, nothing close to what I would say the core of our financial markets. At that time, if you look at trading of Bitcoin, the emergence of Bitcoin, it looked like stocks, but it was nothing like it. Now we've seen a development all the way to the point where companies whose reputation in the market matters are saying, you know what, we think that trading, we think that the custody, we think that those protections around this market are sufficient that we're willing to put our name on it and offer that product. That's actually an incredible development, not one that I expected. I was very skeptical of trading in the Bitcoin market when I was SEC chair. I thought, you know, there were studies that 90% of it was wash trading, ripe for manipulation and the like, large people dumping. You know, the fact that we have these institutions that know markets better than anybody and are saying, you know, we're going to put our reputation behind it, I find that pretty remarkable.
Can they say no to a spot ETF? Well, for how much longer?
Well, it goes to that issue. I think that when the SEC approved the futures-based ETF, they said, let's look at the futures market. We see the surveillance, we see the protections in that market for the end investor that are sufficient. We don't see them in the spot market, so we're going to make that distinction. I think what the institutions are arguing is that those distinctions have gone away, and now the spot product is actually less drag, more efficient for the investor. So if there's not that delta in regulation, not that delta in what I could say efficacy, the spot should be approved. That's the argument that's going on right now. Look, the regulatory process, whether it doesn't matter.
It's been a while already.
It's been a while already. What I would say is this: if they're right, that you can demonstrate that the spot market has similar efficacy to the futures market, you know, it would be hard to resist approving a Bitcoin ETF.
Really? Now, for those of you who don't know, that guy is who screwed us in 2018, 2007. In fact, was it November or December? December 5th, no, December 18th, 2018. Jay Clayton is who approved SEC futures on Bitcoin. He screwed us. Now, Jay Clayton is now saying this should be approved. All right. Jay Clayton, for those of you who don't know, Jay Clayton doesn't say a plucking word without BlackRock's approval. All right. BlackRock owns Jay Clayton. That's just the way it is. Look at his past. All right. I get a great point. I think Jay Clayton owns some Bitcoin. I'm surprised they did not ask him if he owned any Bitcoin. I'm very surprised. I would have asked him, hey Jay, you bought any Bitcoin lately? Because Jay Clayton's not going to get on television and go, I think that these educated and these influential people, BlackRock, I think they'll get approved. I think so. He's not going to say a damn word about BlackRock unless he's ran it by BlackRock. Once again, BlackRock owns these guys. Lock, stock, and barrel. All right? So we got Jay Clayton. Oh, yeah, the bit. Oh, hey, by the way, I'm in St. Louis. I got me some Quick Trip. It's been so long. Pow, chicka, pow, pow, chicka, pow, pow. Oh, say it with me, folks. Mother's milk. Oh, Quick Trip. Where's my sponsorship, you cheap bastards? Okay, now let's get rid of Jay Clayton. Now, we're going to go over here and we are going to listen. All right, folks. Now, this is going to take a while, right? But this is so important. This is why I want you guys to watch this and watch it good. This gal, oh my God. Of course, she's a redhead. This gal puts these four through the ringer. I mean, literally through the ringer on this. Listen closely, folks. Listen to what this gal and listen to what the four central bankers the heads of the central banks. Listen to how she eats them up and how they wiggle and how they try and get out of things, because she asks what are called a backup question, where she'll ask a question and then she'll back it up, right? I don't know how this woman even was allowed to be the moderator of this. There's no way that this would have happened a year ago. No way in hell. Watch, folks.
Bank, the Federal Reserve, and the Bank of England have all raised rates. Even the Bank of Japan is considering unraveling its debt. Hello and welcome back to the final panel of our conference. Inflation is lingering. The European Central Bank, the Federal Reserve, and the Bank of England have all raised rates. Even the Bank of Japan is considering unraveling its decades-long ultra-loose monetary policy. The question now is, how long will policies have to stay?
All right, hang on. I just wanted to jump in. You have to, as soon as I started watching this, all right, as soon as I started watching this, did you see how she said, even the Bank of Japan has started to loosen up or tighten up on their decades of loose monetary? As soon as I heard her say that, I said, oh, hell no. Oh, hell no. She just went from the get-go. She went to the jugular of the Bank of Japan. You don't talk about 25, 30 years of the Bank of Japan's manipulation, especially, all right, especially in front of these people. Give me a like and subscribe on whatever channel you're watching. Let the show continue.
Stay in restrictive territory to bring inflation back to institutions' 2% goals? And is it possible to do so without creating a recession? Ladies and gentlemen, the members of our next panel will bear a great deal of responsibility for bringing inflation back down to 2, and not only that, but keeping it there. Sarah Eisen, the closing bell anchor at CNBC, will be moderating this session. Sarah, over to you.
Thank you so much, Claire. And let me just say, as a business and financial journalist who started out in foreign.
Here we go, folks. She just handed off the club to another woman about to club the shit out of these people.
Exchange. This is pretty much as good as it gets. So thank you for having me talking to the big four today. And what I love, I'm excited for this conversation because it's always fun when everybody's in different places and going at different speeds and maybe disagreeing, if you dare to do so today. So thank you all. President Lagarde, I'll start with you as the host of this meeting. On The View from Europe, I'm curious where all of you are in terms of this policy path We've certainly seen a fight against inflation. You've been very clear that there's more work to do. How much more?
Thank you so much, Sarah. It's very nice having you in this closing moment. And I'll take this opportunity to thank all the contributors, those who have prepared papers, those who have worked with the presenters, and all the panel members. It's been really, really a rich conference, and I want to thank you. So, as far as the European Central Bank is concerned and the Eurosystem at large, we have covered a lot of ground. We have increased our interest rates by no less than 400 basis points in very short order, less than a year. And we still have ground to cover. And I think that, as I said earlier on, we are data dependent. We will decide on a meeting by meeting basis, but we know that we have ground to cover. And if our baseline stands, then we also know that we will very likely hike again in July.
What about September?
That I will not tell you, and for a very simple reason that I just mentioned, we are data dependent. We'll decide meeting by meeting, and we'll tell you for the September meeting, we will have received a lot more data, information, survey results, and it's going to be another projection meeting prepared by the staff of the ECB. So we will have a lot in our hands to make our decision then.
Governor Bailey, you surprised the market recently, raising interest rates by 50. You did a double. Why did you feel the need to do that?
Well, it really picks up on the theme that Christine has just developed. First of all, I mean, the UK economy has turned out to be much more resilient, and that's a good thing. I mean, there's many good aspects to that, but what goes with that resilience is signs of a very tight labour market, which is showing through in pay awards, but also showing through. I mean, we have an unemployment rate of 3.8%, which is historically right at the low end. So that resilience is coming through that way. But when we looked at again, to Christine's point, when we looked at the data, because we too are being driven by evidence at the moment, the cumulative data, both particularly on the labour market and on the inflation release we had, which to us showed clear signs of persistence, caused us to conclude that we had to make really quite a strong move at that point. It was justified. My own view on that was, if we were really of the view that we were going to do 25, and then we were really sort of baked in for another 25 based on the evidence we'd seen, it was better to do the 50. And then we will, as Christine said, we will be evidence driven. So we will wait for the next set of evidence for our next meeting, which, to Christine's point again, will also be one where we will have a full forecast.
Have you received a lot of flack for the move?
Well, I think at the moment, I can understand why there are critics of us and central banks. We have a job to do. I'm very clear that our job, all of us are very clear, I think our job is to return inflation to target, and we will do what is necessary. I understand the concerns that go with that, but I'm afraid I always have to say that it is a worse outcome if we don't get inflation back to target.
Something I know you've all been saying. Chair Powell, you've said it many times, and yet you paused, but you're not calling it a pause, and you're not calling it a skip. So what are we calling it?
Well, first of all, Sarah, thank you, and Christine, thanks for hosting us here in Sintra. So what we're calling it is maintaining the level of the federal funds rate at its current level for this meeting. Thank you. And we did that. If you think about it, we've raised the federal funds rate by 500 basis points since a little more than a year ago, and we think so. We've come a long way. We also think that there's more tightening power coming through. Really, policy hasn't been restrictive for very long. We started at negative real interest rates, and we've now moved up to where we actually are in restrictive territory, but we haven't been there very long. So we believe there's more restriction coming, and what's really driving it, to Andrew's point and Christine's as well, is very strong labor market. We've got a labor market that, where jobs are being created, there's strong wage gains, and that's driving spending, driving real incomes and driving spending, which is driving more demand and continuing to drive labor market. So the labor market is really pulling the economy. And my colleagues and I, as you will know, wrote down in our SEP 2 more additional rate hikes. The median was quite a strong majority, actually wanted 2 or more. rate hikes. And the reason for that was, if you look at the data over the last quarter, what you see is stronger than expected growth, a tighter than expected labor market, and higher than expected inflation. So that tells us that although policy is restrictive, it may not be restrictive enough, and it has not been restrictive for long enough.
So I don't get why you didn't raise rates at the last meeting, especially I think it was a surprise that it was a unanimous decision to hold rates steady when you said a majority think that they still need to go farther on raising rates.
It's really just as you get closer and closer to the goal. What we're aiming for is a stance of policy that's sufficiently restrictive to bring inflation down to 2% over time. As you get closer to that, you get closer to the place where the risks become more in balance. So, we did 4 75 basis point hikes in a row starting in June of last year. In December, we moved down to 50. Then we did 3 consecutive 25 basis point hikes. So this is really just a continuation. We're going to move the decisions a little bit, make them with a little bit more time in between them, in an effort to get more information from the data to see how much restraint is really coming from these, through the pipeline, from rate hikes that we only made now, in many cases, 6, 8, 9 months ago. So that's why we did it.
So maybe in every other meeting hike.
We've not decided that. So the only thing we decided was not to raise rates at the June meeting. We have not made a decision to go to that. It may work out that way. It may not work out that way, but I wouldn't take, moving at consecutive meetings off the table at all.
I'm trying. Governor Ueda, first of all, it's great to talk to you. We haven't heard much from you outside of your policy meetings in Japan. I think the world wants to know why you're the global outlier here. You have decided to maintain your easier monetary policy in the face of rising inflation. Why?
So a simple answer would be, although the headline rate of inflation is above 3%, which is well above the 2% inflation target, we think underlying inflation is still a bit lower than 2%. That's why we are keeping policy unchanged at the moment.
Even though we've seen measures, including core, right, higher than the 2%
the usual
level.
Core is also above 2%. But let's say, let's look at the rate of increase in wages, which is an important determinant of underlying inflation. It has risen, but is now running at around 2%. Now, if you want a 2% inflation rate, wage inflation that's consistent with that would be slightly or well above 2% if you assume productivity growth rate is positive. So there's still some distance to go, we think.
And as a result of your policy being different than all these policies of your colleagues, the yen has gotten very weak and continues to weaken by the minute. Is it too weak?
Well, the yen is being influenced by many factors other than our monetary policy, including the policies of these 3 banks. So we'll see. We monitor the situation very carefully.
Monitoring the situation?
Yes.
For intervention purposes?
No, it's the jurisdiction of the Ministry of Finance. Decisions on intervention.
President Lagarde, how much would you like to see inflation moderate from these levels? Because we've already seen a nice moderation for you to feel comfortable taking a pause or potentially going the other way.
Well, this is not what we're considering at the moment, okay? But if I look back at what we've covered, inflation was, I think the highest reading we had was 10.3. We are now at 6.1 headline. Core has moved a bit down, but we are really looking at both headlines, which is the measurement that we have agreed in our strategy and that is visible for people, for the consumers of Europe, but we're also looking at underlying inflation. And on that front, we are not seeing enough tangible evidence of the fact that underlying inflation, particularly the domestic prices, are stabilizing and moving down. So we're looking at as many measurements as we can.
Yes, Daddy-O brings up a great point. And And remember, she's a Main Street media reporter. I want to know how she wasn't kneecapped or Clinton while she did this.
Because we want to be in sufficiently restrictive territory for long enough so that we are confident that we reach our 2% medium-term target.
Why is it so sticky, Governor Bailey? And why is your inflation rate higher than that of Europe's?
Well, let me distinguish headline and core for a moment. So with headline inflation, I do expect it to come down markedly this year, as we've been expecting for some time. And a lot of that is to do with the fact that the unwind of energy measures in the UK is on a sort of somewhat longer track, so that we will see some quite sort of discrete sort of jumps down in headline inflation in the UK throughout the rest of this year. And indeed, actually, you know, energy prices are now somewhat weaker anyway than we thought they would be even quite recently. So it's core that's the issue, just as Christine has said. Core is much stickier. I think I come back to the labour market again. We have a very, very robust labour market and strong labour market in the UK. One of the striking things about the UK is that the size of the labour force is smaller than it was at the outbreak of COVID. So we have had a shrinkage of the labour force. We're seeing some reversal of that now, but we're still not back to where we were pre-COVID. So that is causing you know, the position in the labour market to be very tight. And I see this when I go around the country talking to firms, because you know, what they say to me very frequently is that their plan is to retain labour as much as they can, even in the event of a downturn, because they've been concerned and it's been difficult to recruit labour. So that's certainly taking place. So I would say there's a backdrop of a very tight labour market going on.
Is it Brexit related also?
I don't think Brexit is a part of that labour market story. I think a lot more of it is actually to do with, frankly, you know, the response to COVID. I mean, we've seen people. UK is a little unusual in this respect. We saw people come out of the labour force during the COVID period. Other countries have tended to see that position reverse more quickly and more strongly than we've seen in the UK.
Governor Wada, when it comes to the inflation path for you, I mean, I know you'd like to see it continue to rise from here, right? What would it take for you to really strongly consider abandoning the yield curve control and negative rates?
So we have a forecast or a projection of inflation.
Okay, I just got to bring this up. She just said, right, the 3 words you're not supposed to say to the Bank of Japan: yield curve control, right? This guy does not get this question ever. The Bank of Japan is known for yield curve control, or manipulation of the bonds, right? But no one ever calls them out on it. Nobody. The fact that she even used the terms yield curve control blew my mind.
Inflation path that looks like it's going to go down for a while toward the end of this year on declines in import prices, and it's spill over to domestic prices. And from there on, we are forecasting some increase in the rate of inflation into 24. But we are less confident about the second part. If we get if we become reasonably sure that the second part is going to happen, that could be a good reason for a policy change.
If you see a steady increase.
If we are reasonably sure that the second part of the forecast is going to.
But didn't you learn from these three that inflation turned out to be not transitory?
Excuse me?
I mean, wasn't one of the lessons from the last year that inflation wasn't transitory and that
Shot
was not,
over the
that there's some
bow.
elements of it that are sticking and
The
proving difficult to fight?
transitory word.
Right. So the second part is the sticky part, but it's still, as I said, we think less than 2%. We hope to make sure that it's going to go up to 2%.
Chair Powell, we've seen some progress in the US. Certainly, if you look at the headline CPI from 9% down to 4%, I know you're focused on core, but what would make you feel better about it that you could remain on hold?
So the progress on headline inflation coming down is certainly welcome and ought to help keep inflation expectations anchored. But I think it actually helps to think about core inflation broken into three pieces. The first of which is goods inflation. And we've seen goods inflation coming down for 6 months now. And that's because supply chains are improving, the shortages are more or less gone, and also because consumption is moving back to services and away from goods. So that part of the story makes sense. Housing services is the next piece, and between that and goods, you have a little bit less than half of the total index. And you see now the new rents that are coming in are at lower increases or no increase. And so there's significant disinflation in the pipeline there, but it's going to take 12 months or 18 months to get there. The place where we haven't really seen much progress is in non-housing services, which is a little more than half of our core PCE inflation index. And that's, hotel services, travel services, food service, financial services, healthcare, those things. It's a generally very labor intensive. Some of it's quite cyclically sensitive, some of it's not. The point is, that's where we're not seeing a lot of progress yet. And the reason is that, or one explanation for it is that labor costs are really the biggest factor by far in most parts of that sector. And so what we need to see, we've seen a lot of signs of softening in the labor market, but it's just kind of beginning. We need to see a better alignment of supply and demand in the labor market and see more softening in labor market conditions so that inflationary pressures in that sector can also begin to subside.
Are you surprised that hasn't happened yet after 500 basis points of tightening already in a little over a year?
Yes, I think widely it's been surprising that inflation has been this persistent, but I think the bottom line is that policy hasn't been restrictive enough for long enough to start to see those effects. And the service sector is not especially interest rate sensitive, by the way, as opposed to, for example, the goods sector. So we wouldn't expect it to be the first to be affected, but we would ultimately expect, as demand softens and as the labor market conditions go more into balance between supply and demand, we would expect to see inflationary pressures subside in that sector as well.
Do you guys coordinate? Do you talk amongst yourselves?
Yeah, of course we do.
I mean, do you call before policy meetings?
Can I I just want to follow up on what Jay said, because I think he's completely right. And I think that this is what I call the catch-22 issue, where we have an expected catch down where manufacturing eventually will align, or services will align on manufacturing. And that would be the logical consequence of the lag time that it takes for services to align with manufacturing and to, see prices go down in that sector. The catch up is that of labor, because it is, as Jay said, labor intensive. It's generally relatively low productivity and low skilled jobs in those sectors. And also those jobs that are going to seek the catching up with pre-COVID times. And how that catch down, catch up will be resolved is going to be critically important for where inflation is heading. Because if we see inflation going down in that service sector and movement of wages while increasing at a moderate pace, then we would be in a relatively good place. But that is totally question mark for the moment.
Yeah, it sort of raises the question, Chair Powell, about whether we need to see a much higher unemployment rate in the US, and you're all dealing with a tight labor market, to finally really break inflation?
So, you know, that the way we think about that is that there seems to be a path still for labor market conditions to soften and for demand and supply to get back into balance without the kind of large job losses that have happened in many prior cycles. And the reason for that is the level of job openings that still exist in the labor market. So it's still set 1.7 job openings for every person who counts as unemployed. That has been coming down. It's come, actually, the number of job openings has come down now by almost 2 million. And what you're seeing is wage pressures. They're still high, but they're definitely coming down. You're seeing surveys of workers and businesses suggest that the labor market is not as tight as it was a year or two ago. So you're seeing a job creation is beginning to come down. There are a number of indicia that would suggest that we're getting the softening that we need. We're getting it slower than we'd expected, but nonetheless, it's happening. So it's still a possibility there. But you know, it's so uncertain right now. That in my view, the least unlikely case is that we do find our way to better balance without a really severe downturn. I think there's a significant probability that there will be a downturn as well, though. But it's not to me the most likely case.
That's the hard landing scenario.
Or just this. I wasn't even thinking of hard landing. I was thinking of even a recession. To me, it's not the most likely case, but it's certainly possible. And of course, many forecasters do predict that.
Is Europe in recession, President Lagarde? I mean, we've seen 2 negative quarters of GDP. I don't know how you define it. But
I think the first quarter of 23 was actually completely flat, wasn't negative. So technically, I think you could argue that we did not see a recession, but it's stagnant, to say the least. And the expectations for Q2, particularly in the industrial sector, if I look at PMI numbers, are not giving us great hope that there will be a strong recovery. We see a second half of 23 up from the first half, certainly, but moderate. We have a 0.9 forecast for the whole year.
Do you agree with Chair Powell? Do you think you can get away with this tightening cycle without dragging Europe into recession?
Our baseline does not include a recession, but it's part of the risk out there.
Are you willing to tolerate a recession?
Well, the interesting thing for us is that if you go back to last November, when we did a forecast, we were predicting quite a long but quite shallow recession. And the economy, as I said earlier, has turned out to be much more resilient so far. Now, I think you can sort of point to a number of things that underlie that. One of the things I would point to is the fact that we've had a very sharp fall in energy prices in Europe. And that obviously has helped with the whole question of the terms of trade shock that we've been having. It's done quite a bit to reverse that terms of trade shock.
All right, here's a quick word from our sponsor. We'll be right back.
Are you buying and selling on the same laptop that you're using to browse the internet, read your email, and visit social media sites? If so, you're exposing your cryptos to theft. Whenever you're online, you're at risk of having your identity stolen. How would you feel if someone stole all of your cryptos? What would that do to your finances? Guard your cryptos with a safe and secure laptop from CALIX Solutions. Each laptop is set up just for you and your cryptos, and then we walk you through exactly how it works. Don't risk the security of your cryptos. Order a crypto laptop from CALIX Solutions now to secure your crypto future. Learn more at calixsolutions.io.
And that feeds through into national income. So I'm not surprised that we've had this reversal in one sense. What was surprising, but actually very helpful, was that, of course, we did have this big fall in energy prices and a much better winter, frankly, than we thought we would have. So, we're going through this year now in a more resilient position than I expected. So we're not currently forecasting it, but obviously we have to watch it very carefully.
How's the Japanese economy faring? I mean, it's very exciting if you look at the Japanese stock market at a 30-decade high. What's happening fundamentally?
It's doing fairly well. I mean, apart from the contribution from some inventory investment, domestic economy is expanding at a pace slightly above potential, I think, driven by pent-up demand, we relaxed pandemic-related restrictions in May, and this is stimulating consumption and investment. There's also green GX, DX-related business fixed investment taking place. So investment is fairly strong at the moment. We think the economy is going to expand at slightly above potential for some time. But there's, of course, a lot of uncertainties going forward, including what may happen in Europe and the United States.
I asked if you guys coordinated or talked about monetary policy before. I mean, does that happen? Should it be more coordinated? Because you're all doing different things right now.
Well, I mean, I'll start. I mean, obviously what we don't do is say, what shall we do, what shall you do? Because we're all setting monetary policy for our areas, and that's the law in all of our areas, actually, so we don't do that. But we do talk a lot, and I think it's important. I mean, it's important at all times, but it's particularly important in recent times at the moment because we're facing such big global shocks. We've got common shocks. They differ a little bit in terms of their impact and their effect, but there's some huge global events going on that are affecting all of us. So, I think we do talk quite a lot and we see each other quite a bit because it's important we do that. And, we share wisdom on how we're sort of interpreting the things that are going on around us.
Yeah, I guess we are in a flexible exchange rate world, so we do policies independently. But of course, we exchange information, which is very, very valuable.
Do you think that, Governor Ueda, do you think that they are over-tightening?
No.
No, you don't. You approve of the policy. You've had a very tight labor market for a long time in Japan, even before COVID.
Yes.
Demographic issues
demographics.
There. Yeah.
It's working in a way to tighten the labor market for quite a long while. And it's going to continue this way for a while.
I mean, the economic conversation, it gets into an interesting question, Chair Powell, where now we're wondering, easier to fight inflation last year when the economy was doing better. But now that we're seeing signs of softness and weakness in manufacturing, and you mentioned the labor market starting to cool off, about overdoing it and the risk of overdoing it. Do you wonder about that, or you're still just focused on inflation?
Let me say the U.S. economy has actually been quite resilient, and the data that we're still seeing, including since the last meeting, still is consistent with with an economy that's resilient and growing albeit at a modest pace. As I mentioned earlier, though, yes, there was no question. The first question was how fast should we go, and we went pretty fast, and we got to a level that we believe is restrictive. We're in restrictive territory. If you take the federal funds rate and you subtract some forward-looking measure of expected inflation, you'll get a significantly positive real rate, meaning we're probably in restrictive territory. So, and I think we have steadily slowed the pace of our moves, and it's appropriate to do so for one reason, because the more information we get, the better decisions we'll make. The risks of doing too much versus doing too little become more in balance. I wouldn't say they're in balance yet, but they're becoming closer to balance. I still believe and the committee clearly believes that there's more work to do, that there are more rate hikes that are likely to be appropriate, though.
So you think the risk is still of doing too little and not getting control of inflation?
Yes, and of course
But inflation expectations are, I don't have to tell you, very well anchored.
No, but the thing with the risks is that there may be social costs associated with restoring price stability. The social costs of failing to restore price stability will be higher in almost all likely cases. We've seen what that looks like, and it's just something that we have to do. It's the one of the principal things that society counts on us to accomplish, and I think we all feel committed to accomplishing it. It is of course a good thing that inflation expectations have remained anchored all this time, but our understanding of inflation expectations is not a precise one, and the longer inflation remains high, the more risk there is that inflation will become entrenched in the economy. So we have to
see. This is what I was saying. Is every time that they try and give some horseshit answer, she's actually she's going right back at him. This doesn't happen to these people. This is not how this should be going in their heads. Now, this is a real interview. They are not used to this.
The passage of time is not our friend here.
What about a higher inflation target? I know none of you want to talk about that, but on Wall Street, there's this idea that a lot of things are changing in our economy structurally. The onshoring of supply chains and chip plants and all of that is going to be expensive and could permanently create higher inflation rates. Couldn't it, President Lagarde?
Well, at this point in time, and given the fight that we lead against inflation, the yardsticks that there is, the strategy that we've agreed, the expectations that we have, and the inflation targeting as it has been set, there is no way that any of us, I think, would consider changing the gatepost halfway or more than halfway through that journey. I think it's wonderful to have a forum like Sintra, which brings together academics and other than policymakers to actually consider those ideas and to explore them and to weigh the cost and benefit and all the rest of it. But at this point in time, I think we have to be as persistent as inflation is persistent, and we have to be and decided and determined in reaching the target that we have set, and not debate the target as we are running that race.
But it does raise the question, Governor Bailey, about how far inflation will come down to.
It does, but let me reinforce what Christine said. What is the inflation target? It is the definition and practice of price stability. In our legislation, it is what price stability is taken to be. That is the 2% target. And I don't think anything has changed in terms of what we mean by price stability. And I think that's a very important point to start with. It's the anchor that we have to always maintain. Now, in terms of bringing it down, yes, I mean, we're facing, have faced and are facing the biggest challenge for a very long time. But we have to meet that challenge. I don't think it is the right thing to do to say, well, this is all a bit difficult, let's change the target. I really don't think that is the right thing to do. I think that would be a very bad thing to do. And I think, although I very much agree, as Christine was saying, that there are things we understand about inflation expectations and things we don't understand about inflation expectations. I think taking risks of that nature with inflation expectations, but also fundamentally changing what we mean by price stability when there's no good reason to do that, I think would just be the wrong thing.
How do you read, Governor Ueda, the inflation expectations? Because they've crept up in Japan as well.
Yes, we've been for a long time trapped in a zero inflation expectations equilibrium. So we've been trying very hard to move this to a 2% inflation, 2% expectations equilibrium. To do so, we had to de-anchor expectations from zero, raise inflation expectations, and in the future, we'll have to re-anchor them at 2%. This is a formidable task. And now we are seeing signs that inflation expectations are rising. But as I said, not to the extent that we are fully in the 2% inflation expectations equilibrium.
It also raises the question, you mentioned the labor market and some of the post-COVID changes about just how COVID has distorted the data and has made travel, for instance, so strong for so long. And I wonder, Chair Powell, how you look at the COVID impact on the economy and how it's changed the way you make forecasts and you think about what's happening right now.
Well, I think there are changes, and we don't know how persistent they will be. Certainly work from home, and you can see the effect on commercial real estate, particularly office real estate and the surrounding retail that's suffering in many major cities. We don't know how long that will last. It feels like some part of that will be persistent and will last. You mentioned the data as well. I guess response rates to a lot of the data that we collect and the other organizations collect, the response rates have gone down, and you're seeing a lot of volatility in some of these data series, more so, I would say, more so than we've seen historically. So the data are even a little bit foggier than they usually are. But we'll be, in terms of what the effects of COVID, it's going to have long-term effects on the economy. There may be loss of productivity. There's certainly been, for a generation of kids, some loss of education and training. I think it's hard to say how persistent all this will be.
What is your level of concern of commercial real estate, since you mentioned it in the U.S.?
It's something that we, of course, are watching carefully. The way it lays out is the large banks don't have large concentrations of commercial real estate. So that's a good place to start. A surprisingly large part of exposure to commercial real estate is in the banks that are under 100 billion. But there, the worry is more banks that have a high concentration, and they're relatively few. So it's something that we're carefully monitoring. Bank supervision has a playbook for this. So supervisors are talking to banks about their concentration of real estate and what can they do and how do they manage themselves out of this. It's something that we're well aware of. It's not a surprise, and we're focusing on it.
Is it one of the reasons you were cautious in the last meeting?
Commercial real estate? I wouldn't say so. No, I just, generally speaking, it was at the last meeting, it was about, what's in the pipeline, how far we've come, what's in the pipeline. I will also say that, though, that the bank stress that would part of the decision, in my thinking anyway, was the bank stress that we experienced earlier this year. There's a fair amount of research showing that when something like that happens, bank credit availability and credit can move down a little bit with a bit of a lag. So we're watching carefully to see whether that does appear. Of course, tightening in financial conditions is what we're doing intentionally. So we have seen bank credit conditions tighten. The question is, and that's what we're trying to achieve. The question is there another channel of that or a greater amount of that coming from what happened in March? We don't really see any evidence of that, but I think that's certainly in the back of my mind to see whether we do see that.
Yeah, it gets into the question about lags. How long are lags, Governor Bailey? And do you expect to see more?
It's a very interesting question in terms of the transmission of our monetary policy decisions. So if I can just illustrate it with the UK case, and obviously it's not the only part of the transmission mechanism, let me be clear, but it's an important part, and illustrate it with the UK mortgage market. So we've seen a big structural change in the UK mortgage market since the last tightening cycle of monetary policy, which of course, accepting passage of time, was about 20 years ago, actually. And that change has been a change from a variable rate mortgage market to a fixed rate mortgage market. Now, I must say, obviously with Jay here, it's not a US style fixed rate mortgage market. It's a much shorter term. So the average term is often around 5 years. But we know, and we think around about 85% of the stock of UK mortgages are now sort of in that part of the market. So we know that the transmission of monetary policy is going to be slower as a result, because obviously it depends upon the sort of the timing and the sequence of those fixed terms coming to an end often. So we have to judge that. I mean, it's another factor and another sort of element of uncertainty that we have to judge when we're taking our decisions, which is how much of the tightening that we've already done has come through and how much is yet to come through. And we know that referring back along quite a way into the past isn't going to help us in that respect. So we have to sort of formulate those views afresh. And so it is part of our decision-making calculus is how much more has to come through, when will it come through, and also how powerfully will it come through. And all those things are things we have to take into consideration. And as I said, history isn't going to be a great guide for that, given the change in the market.
So a year? What's a lag?
Well, what you see, and of course you can compute, is the sort of the profile of mortgages coming up for renewal. Yeah. Renewed terms, and we can see that over the next year or so, there's quite a lot of fixed rate mortgages are coming up for renewal. So yeah, we can factor that in. There is another element, I say, of uncertainty as to just how that will work its way through.
President Lagarde, how do you think about the lags?
I think of the lag in three steps, if you will. The first one is transmission in terms of tightening of the financing terms that are made available and how markets absorb the decisions that we make. And on that front, we have a good and reasonably rapid transmission. We see it in rates, we see it in volume of loans, and on both accounts, there is a good absorption and a rapid transmission of our monetary policy decision. But that's only step one. What we need to see is step two and how it materializes on investment by corporate. And for households, it's predominantly mortgages. And for the euro area, there is a lot of heterogeneity because you have markets where mortgages are at fixed rate, markets where mortgages are at floating rates, some that are readjusted every so many years. So we have to look at all those data very carefully. But it seems that the transmission is likely to be less rapid than it had been in the past because there are many more fixed rate mortgages now in the euro area than there was, say, 15 years ago. And that's not it. We need to see it then, channel to the third step, which is inflation. So we want to see that transmission strength through step one, step two, step three, and make sure that this is really having an impact in terms of the fight we have against inflation.
Governor Ueda, do you worry about the impacts, the lagged impacts of their policies on the global economy and on your economy?
Oh, yes, but for ourselves, we haven't had any serious monetary tightening for 3 decades. I was a board member of the BOJ 25
It's
years
much.
ago.
This is part of the whole business. What do they do?
20, 30 basis points.
Wow.
Now, minus 10 basis points. So,
and it doesn't sound like it's changing anytime soon.
So in terms of that, the lag in the effects of monetary policy could be at least 25 years. We'll see what will happen if we get to normalize policy seriously. But we'll have to be very careful here.
Be careful what you wish for, I guess. So, Chair Powell, are you more worried about the lag impacts than they are?
These people don't get laughed at, all right? What made everyone laugh was the fact that he was cornered into telling the truth. And that's what people laughed at. And absolutely, these people are petrified. They're like, wait, whoa, ha, shit. That's what's going on.
They are because they're still hiking rates?
I don't know. I wouldn't want to compare. I would just say again, so what's different this time is actually, though, that markets move substantially in anticipation of moves. So by the time we lifted off in March of 2022, the 2-year had moved from 20 basis points up to 200 basis points. So financial conditions now move in expectation, and the whole modern communication strategy really helps that along. So that is different. What may or may not be different, and we also haven't had this kind of tightening in 3 decades. Really, we've had tightening, but it wasn't. This looks more like tightening cycles from the 70s and 80s. So what we see is a picture of literature that has the older literature says a year or two for activity and add a year for inflation. There's new literature that says it's much faster than that, and I think we just have to use our to watch and see what's happening. There are beginning to be there are reasons to argue that it would be faster this time or slower this time, but I just don't think we know at this stage.
Well, it kind of gets into the question about the markets, and you're saying that it's a transmission mechanism. You're all talking very hawkishly and saying there's more work to be done and we're still worried about inflation. The markets pretty much think you're almost done, all of you guys. Maybe one more hike in July and then done, and then into cuts next year. Is that wrong, President Lagarde?
You know, I look at the data we have. I look at the mandate we have. I look at, you know, the
Oh, did you see her body language? Oh, they're getting killed.
the transmission lag, and we've decided for ourselves that we would use 3 criteria. That's what we are focused on. Of course, we are not completely oblivious to what happens in markets, but we have to be guided by what the mandate is, what the data delivers, and what criteria we take into account in order to determine our policy and to establish our stance going forward. That's the only way to go.
But I guess, you know, there's financial conditions, and I don't know, Governor Bailey, are they working against you? You're trying to fight inflation, and MSCI World is up nicely this year.
Well, by the way, I mean, the market, I don't think thinks we're nearly done at the moment. I mean, they've got a number of further increases priced in for us. My response to that will be, well, we'll see, because we are, as we were saying earlier, we're essentially evidence-driven in that sense. So, you know, we'll make our decisions based on that. I think you're right to point out, as you said earlier, and I would draw this point out, that there are 2 parts to this. There's where the peak is, and then how long it's sustained beyond that. And I think both of those are relevant. Both of those are things that will, I mean, sorry to state the blunt and the obvious, will emerge with time. But I've always been interested that the market thinks that the peak will be quite short-lived in a world where we're dealing with more persistent inflation.
Right. I mean, they did finally price out the cuts in the US a few weeks ago. Market was primed for cuts. I assume you were pleased to see that that's no longer the case.
So if you go back and look at forecasts from the participants on my committee on inflation, you'll see, you know, we've been consistently thinking this is going to take some time. It's going to be a process that will take longer than we would have hoped. And it may well be a bumpy process, but markets have gone back and forth between pricing and what appearing to price in pretty quick declines in inflation to coming back to being more in alignment with the thinking of the committee. And that's where we are right now, is closer to where committee participants are. But as Christine said, you know, we're not focused on what the market's forecast is. We have our forecast. All of us who are on the committee, we work hard to develop an understanding of what's driving inflation and what the path forward for inflation is. We make our best estimates. And that still is that it's going to take some time. It's just going to take some time. Inflation has proven to be more persistent than we expected, not less. And of course, if that day comes when that turns around, that'll be great. But we don't expect that. We don't plan for it.
So is it counterproductive to you that the stock market has rallied, the bond market has rallied? I mean, the market is fighting the Fed. The market thinks you're closer to the end. And I mean, that does make financial conditions easier.
Wasn't that the...
You can't fight the Fed, but they're fighting the Fed. Is that a problem?
I don't see it that way. I don't look at it that way at all. Honestly, we have different jobs. You know, our job is to bring inflation down to 2% and sustain maximum employment. That's our job. That's what we think about. We look at the data, and that's what we care about. And markets react, different parts of the market react in different ways. It's just not something that is a principal focus of our work.
But it did seem last year like you wanted a weaker stock market. You used the word pain at Jackson Hole. It seemed like you were trying to communicate that financial conditions should tighten, and less so this year. Is that right?
Not really, no.
Okay.
Of course, we work through financial conditions. That's what we do. Our rate and our, you know, all the things we do and say work through financial conditions to affect the real economy. That's how it works. But it's broader financial conditions. So we're not focused on any one market. We're never thinking, oh, let's do this to this market. It's just in general, let's communicate what we want to do and why we want to do it. And financial conditions adjust. And that's really all we can do. We do not target particular parts of the market Although, of course, we do monitor market conditions.
So you don't care what the stock market's doing?
I look at broader financial conditions. It's
Okay.
one of many, many conditions, along with interest rates, credit spreads, everything, all of the conditions and the availability of credit. It's one of many, many things. Again, we don't focus on any one thing as the key thing.
Governor Wada, how important is it to you, the markets, as it relates to financial conditions and the mechanism for monetary policy?
You mean the stock market?
Stocks, bonds, currency.
So stock prices have been rising fairly sharply since spring this year. Stock prices theoretically are affected by interest rates and investors' view of the economy. We haven't changed interest rate, so probably investors have become more optimistic about the future of the economy. Of course, we don't want serious financial imbalances in the economy, so we keep monitoring.
How do you think about, President Lagarde, the risks to the economy, especially geopolitical risks? In Europe now we were all glued last weekend to the news out of Russia and the Wagner rebellion, and we're wondering if now political instability in Russia presents a further geopolitical risk to the global economy.
Well, I think I look at it, we all look at it, and we are all concerned about geopolitical development by virtue of the profession that we have, because it does have an impact on supply chain, it does have an impact on trade, it does have an impact on the uncertainty, and we can only say that at this point in time, uncertainty is high overall, and a big factor of that uncertainty has to do with the geopolitical difficulties and conflict or quasi-conflicts that abound at the moment. So yes, we are looking at that, but do we have to make a moral judgment on this, that, or the other? This is not the job that we have, but it clearly has an impact on how the economy is going to change and be transformed, and whether it will have an impact that is inflationary or disinflationary, I think is also to be determined. I think there will be various schools of thought along those lines.
Yeah, I wonder how you think about next winter. I mean, Europe got lucky.
We hope it's mild.
What if it's not?
But storage is what, 69%? Michael, the expert on Isabel's panel, said that 69%, and we are going to hit 95% by the end of the summer. So that should put us in a good position for the winter. But I'll say one thing, which probably we had not factored in sufficiently, and maybe that applies to all of us. It's the resilience of our economies and the resilience of the entrepreneur, the corporates, the way in which we have sort of, in a matter of a few months, reorganized ourselves. Just think 1 year back, everybody thought that the German model was dead, that Europe was going to be completely on its knees. Well, these things have not happened, and the resilience has been demonstrated at all levels of society.
I totally agree with Christine on this. That resilience, I mean, you see it when you talk to businesses. I spend a lot of time talking to businesses, and I've spent a lot of time in recent months talking to food-producing businesses to try to understand the sort of, the slower than, frankly, we expected decline in the rate of food inflation. And one of the things that I get quite consistently, and this is where sort of the Ukraine-Russia situation comes through for real, is they say, well, last year we brought forward sort of supplies to a much greater extent than we would normally do because we were not confident we could actually get them. Consequences, we've locked in higher prices for, sometimes they say 6 months to me. And that, of course, is affecting the passage of inflation, particularly for food prices in this case. So these things do have a very direct effect and are continuing to have a very direct effect, actually.
But there's nothing central bankers can do about that, is there?
Well, I think the first thing we need to do is understand it. That's a good starting point. Well, we have to then design.
You can always just keep crushing demand, but you can't do anything about food supply.
We have to design policy. I mean, we have to design policy and take our decisions with the best. We always take policy. We always take policy decisions on a forward-looking basis. So we have to do it with the best information and understanding we can get of these things.
So to what extent, I guess, is the war in Ukraine driving supply side inflation for materials around the world.
Well, following on from what I was just saying, I think the conclusion I draw from that is, and this is what the businesses tell me, is yes, we are going to see actually a fall in the rate of food price inflation, for instance, but it is taking longer than we expected. So that's what we have to factor in and decide how best to, in a sense, to respond to that with monetary policy.
It's not just Russia. Governor Ueda also, we're following the tensions that have increased between the US and China, between Europe and China. Do you think that's having a material impact on global growth?
Well, at least there's a tendency to relocate production sites out of, say, China into other Asian economies, including to some extent Japan. So in the short run, this is having a small positive effect on the Japanese economy through business fixed investment. But in the longer run, there will be inefficiencies all over the place. So we'll see.
So Japan's a beneficiary of the flight out of China?
In one sense and in the short run, but in the long run, I'm not sure.
I mean, Chair Powell, how do you think about, it's obviously a risk and it hurts trade. How do you think about the US-China relationship as it impacts the economy?
So that is the way we think about it. We don't have any role to play in the relationships between the countries, but China's a very large, important economy. It's a big trading partner, mainly consisted of us buying things that are made in China. I don't think, and of course, the Chinese economy came out of the COVID and looked like it was recovering strongly. Now it doesn't look like that. It looks like it's slowed down, and there's some issues there. From the U.S. standpoint, at the margin, that probably means a little bit less global demand. I wouldn't say it's a first order consideration for us, though.
How does Chair Powell reference the disappointing nature of the Chinese economic recovery? How does that play into Europe's recovery or the global growth picture?
Well, first of all, I think we have to be attentive to the emerging market economies at large. At the moment, they are producing about 60% of global growth, some of which is now a bit more focused on domestic development and consumption, and less so on trade. But if you look at the trade volume numbers from China to many other countries, particularly the advanced economies, that has not changed significantly. So the trade volume is still significant. And I'm not breaking any news here. The Chinese authorities themselves say that they're likely to have a 5% growth this year in 23, rather than the 6% that they had initially forecasted. So that will have an impact, given the size of the Chinese economy, on global growth at large. We have to, when we do our projections, when we look at the economy, we look at the global economy, and then we sort of narrow down and zoom on the European economy and the euro area in particular. But everything that happens in China, in the United States, in the UK, in Japan, in emerging market economies actually matter for us, because we are strongly interrelated and have been trading with each other for a long time. And if anything we've learned from COVID, in addition to the pain and suffering for many, is the fact that we are vastly dependent for the supply of rare earth and various metals that will be critical for the development of the economy of tomorrow, if we decide to firmly go towards the green economy that we should be aiming for.
As an open economy, one of the things is just exactly as Christine says in terms of how we do our process. One of the things that we spend quite a bit of time on is world export prices. Now, actually, in the recovery from COVID, and of course, this was the supply chain shock, we saw quite a big contribution to goods price inflation from world export prices. We're now seeing those prices definitely start to weaken. So that will be another determinant going forward of policy.
As central bankers, do you plan for the worst case scenarios on the geopolitical front? I mean, if China invades Taiwan, then what? What does a central banker do? Is there a contingency for that, Chair Powell?
We use our tools to achieve our legal mandates, if that happens.
Got that Fed speak down. You'll hold a special meeting. special. No, I mean, it's a volatile world we live in, right? And then
So
there's
we do
impacts.
have, in every FOMC cycle, we look at, our staff works up 6 or 7 or 8 alternative simulations, and they simulate, different things. It's not so much geopolitical events, though. It's more different ways the economy could play out. And we all the participants read those and think about them and talk about them, and they come up in our meetings, we talk about them. So it's very helpful because you can't get too focused on the modal path in a world where it's just very hard to predict the economy. Even in normal times, it's very hard to predict the economy, let alone times like today.
What sort of simulations do you talk about?
I'm going to leave that to your imagination.
I bet I can think of a few. President Lagarde, Chair Powell did talk about, one of the things that I don't know that there was a simulation of is we had a few bank failures in the US this year. And I know it forced some of you into action to shore up banking systems. Are we in good shape now? Is the global and European financial system in good shape? Have we healed?
I can only speak to the banks over which we have supervision, and those are the euro area, the European banks. But I'm looking at the euro area specifically. We have been, enforcing Basel III to the entire banking sector. The capital ratios are very high, 15.3%, if I recall. The leverage coverage, the liquidity coverage ratio, very high as well. So we have not experienced, the turmoil or the difficulties in Europe. And Europe does not include Switzerland. Thank you very much. But we are extremely attentive. We reinforce the stress testing constantly. We are I'm very pleased to see that the Basel III agreement has now been reached, as I understand, between Parliament, the Council, and the Commission, so that we can actually roll out Basel III with as limited exception as possible. And we have to continue doing that job.
Any lessons that you took, Governor Bailey, from what happened earlier this year?
Well, let me start with a sort of bit of backdrop. I think it's important, drawing on what Christine was saying, I think it's important to, in a sense, reflect the fact that the regulatory changes we made after the global financial crisis have paid off, in the sense that we've been through, and we are going through, some huge economic shocks. And the banking system, certainly I can speak again as Christine does, I can speak for the UK banking system, is resilient to them and is doing what we want it to do, which is support the economy, not the other way around, to be honest, going back to the crisis. So that's an important starting point. Now, I think there are important lessons from, important issues that we have to reflect on from what happened. Christine made her subtle reference to Switzerland. Well, there's a huge sense of irony in the British, Christine. Look, there is obviously a question posed by Credit Suisse, handling, which is, are the resolution plans for the major banks that we've spent the last 15 years developing fit for purpose, or are they not fit for purpose? And I'll come to that. If they're not fit for purpose, then of course we cannot sit here and say all's fine, because clearly we're going to, regrettable though it would be after 15 years of work, we're going to have to sort of, tear them up and start again. Now, I'll give you my view on it. I'm going to say this. I have not yet heard the case made to me which suggests that they are not fit for purpose. I'm going to state that, but I'm not going to leave it there. We have got to have, we've got to have this out and decide whether, it goes one way or the other. My starting point is I remain to be convinced of that assertion, but we can't let it rest there. I think we've all got the question of, how our banking systems handle, a steep rise in interest rates. We do stress tests to test that. We've got capital provisions for, related to that. And we've all got to think hard. I think the third thing I'd say is we've got to think hard about the speed of run question. But I think we've got to think pretty carefully about that, because if we go to extremes on that argument, we're essentially heading to narrow banking. And speaking myself, I don't think that is a sensible place to head to. So we've got to think quite carefully, but quite, I think, creatively about how we maintain the banking system that does what we want it to do, which is create credit in the economy, create assets that are naturally illiquid, and deal with this speed of run question. And we've got to take that one on.
We're actually going to get stress tests this afternoon in the US, which I won't ask you about, Chair Powell, but I will ask if you think that the US regional banks are resilient right now.
I do. So I think, first of all, I think the overall banking system is strong and resilient with very high levels of capital and liquidity, double the levels that they were at, and then some before the crisis. So the innovations that we put in place, the regulatory changes and higher capital, those are all in place in the United States as well. So when it comes to the events we had earlier this year with 3 banks that had pretty idiosyncratic business models and funding models as well, I think we need to learn lessons, and we're not hiding from that at all. We understand there going to need to be regulatory strengthening of both regulatory and supervisory practices as it relates to institutions of that general size, I would say.
You got a lot of questions on that from Congress last week.
That's mostly what they wanted to talk about.
They want to make sure that you aren't, in part, not going to increase capital levels and sort of choke off the small and regional banks in this country and make it hard for them to compete.
So the U.S. has something like 4,500 banks. It's the most banks by a pretty big margin, I think, of any major economy. And we think it's a real benefit to have banks of different sizes and business models that serve local communities and offer different products, as well as having the large banks. And the large banks in the United States are very strong, well capitalized, a lot of liquidity. And they've been a source of strength, I think, through the last couple of events. So I think it's important that whatever changes we do make, keep in mind the need to preserve the business models of these of smaller banks and not just of the largest banks.
Any concerns for you, Governor Ueda, on the strength of the global financial system at this point, as we go through this, I don't know, once in several decades tightening period?
I can only talk about Japanese banks. I think they are well capitalized. They're capitalized. They have enough liquidity. It's true that some smaller banks, regional banks, are sitting on non-negligible amount of valuation losses on their security holdings. But on average, that's about 1% of their core loan capital. So it would be okay. But if we do get to normalize our monetary policy, because we go into the 2% inflation rate equilibrium in the sense I discussed earlier, then rates may go up by large margins. And we'll have to be careful. We'll have to be carrying out all sorts of stress tests, I think.
I also wanted to ask you, if you go into a more normalization stance away from negative rates and the yield curve control, how you'll manage the risk of the government's enormous financing needs, and whether that's a concern that you think about.
Well, we keep saying that's the business of the government and the Diet to create sustainable government finance.
Fiscal policy in general, I'm curious if you guys will bite on this. Is it helpful right now or hurtful, President Lagarde?
Everybody has to do what everybody has to do. Man's got to do what a man's got to do. Monetary policy makers have to decide on monetary policy, and fiscal policymakers have to do their job. It is true that there are circumstances where working hand in hand and supporting each other has proved helpful. I think we had a very good demonstration this morning in one of the lectures that we had. I think what we have very clearly stated as a governing council of the whole Eurosystem is governments, please, it's time now to roll down the measures that you had decided for COVID and for energy purposes, and that you adopt a path that will take you to better sustainability of your public finance. So we hope to see that. The fiscal space that has been allowed for the various non-conventional fiscal support that were decided back in 22 and 23 very much should be rolled back in the course of 23 and certainly should not be expanded in 24, bearing another major shock. But that's our recommendation, and we make it very clear in our monetary policy statement and have made it very clear in the last statement that we issued.
I mean, we learned in the UK, what was it last year, when monetary and fiscal policy don't work together, it can be a big problem.
Well, because what we had to deal with in the UK last autumn was actually a financial stability issue, and we dealt with it, and it was very clear that that was the issue we dealt with. We didn't deal with anything more than that. It's not our job to get involved in fiscal policy in that sense. And we always, when setting monetary policy, take fiscal policy as announced, as a conditioning assumption for our decisions. So I don't go beyond that in terms of commenting on the stance of fiscal policy. I mean, the one thing I've said in recent times, and I don't mind saying it again, is that I welcome the fact that the Chancellor is very much using fiscal policy to try to address the structural issues in the economy. That's not a comment about the stance of fiscal policy about more or less. It's a comment about the fact that, going back to the point I've made about labour markets, and actually the low potential rate of growth in the UK economy, that the more we can do to tackle that, frankly, the better.
What about you, Chair Powell? I mean, there's been a lot of fiscal largesse in the United States, the COVID stimulus, and now even new policies that are just filtering through, like Inflation Reduction Act, infrastructure, chips. There's still American Rescue Plan Act money getting doled out. Isn't that making your life harder?
Well, so echoing my colleagues, our assignment is to deliver price stability kind of regardless of the stance of fiscal policy. And we don't play a role, formal or informal, in advising the fiscal authorities. There are other agencies in Washington that do that, and that's really not our job. I will add, though, without crossing any lines, that the spending during the pandemic was very high, and it's come down. And so we look at the fiscal impulse from the level of spending, and it's really not material. It may even be slightly contractionary, but let's just say it's flat. You identified those bills, and I think you are seeing some of that money showing up in construction. It's construction numbers. It's supporting construction activities, particularly the infrastructure bill. But I wouldn't say that that's if you look at where the inflation is in the economy, I wouldn't say that that's an important driver of inflation or something that we think about or consider.
So you mentioned the consumer. So the excess savings, you think have pretty much come down. Where do you think the U.S. consumer is headed?
The consumer had savings from two sources. One was just the fact that people couldn't travel and couldn't kind of spend money on services. That was a lot of it. And there were also the fiscal transfers that happened. And those, there are many different estimates. I would say for people at the lower end of the income spectrum who tend to have a high marginal propensity to consume, most but not all of that money is gone. So there's certainly some residual support for spending in laws that passed at the beginning and during the pandemic. But that's, again, I wouldn't say that's today the main driver. I think if you look at the strength of the labor market, still creating more jobs than there are new entrants to the labor market, and wages are still pretty high. So you're driving up disposable income, and that is driving consumption, and that's driving the economy.
Wanted to also ask you guys about the balance sheet, very hot topic. Governor Wada, how do you think about the expansion of the balance sheet, and how?
Oh, this is where it starts to get good. I mean, really, really good. Because now they're talking about the balance sheets. I don't know if you guys have ever watched a live Federal Reserve event. They do not talk about the balance sheet of the Federal Reserve. That's the third rail. Here we go.
How much is too much?
Well, it's a tough question to answer. At the moment, we are using government security purchases to hit the range for the long-term interest rate we have set, which is 0 ± 50 basis points. So the size of the balance sheet is an endogenous variable.
The rest of you are kind of in shrink mode in the balance sheet or roll-off mode. You've been more aggressive, Governor Bailey. How has it gone smoother than you expected?
Well, so far, I don't want to tempt fate, it's gone very smoothly, actually. By the way, the reason that you say more aggressive, just to be clear, is that we've got a longer duration of bonds in our portfolio, government bonds in our portfolio. So leaving it to an organic runoff would mean a lot longer runoff for us, I think.
That's why you're outright selling.
So that's why we're selling them. So the target we set for the year, the 80 billion target, was the sum of the natural runoff plus the difference between the target we set and that. And it's that element that we're doing as active sales. So that's gone, I would say, very smoothly, actually, so far. I'm very happy with the way it's gone. I think the second question that we're certainly looking at actively, of course, is just how far will we go? And I look at it particularly in terms of the stock of reserves now in the system before we hit what I would call the equilibrium level of reserves. Now, we may go on selling the QE stock below that because we would shift our operations around. I would expect to do that. But it's important to focus on where we think that sort of natural level of the balance sheet, which won't be constant over time, by the way, but where we think that natural level of the balance sheet is relative to where we are today.
How do you think about it, President Lagarde? And is there pressure building for you to go faster when it comes to shrinking the balance sheet?
I would say that the interest rate is the primary tool that we're using at the moment. Second, there is almost a contractual reduction of the balance sheet of the ECB because there is a reimbursement of the TLTRO that we had put in place during the pandemic, and that is actually happening now, if not yesterday or the day before. Third, as of the 1st of July, we will stop any reinvestment under the asset purchase program. So there is a natural declining of the balance sheet of the ECB, which is only a first step. We are discussing our operational framework. Hopefully, we will be able to complete that work in the next 6 to 9 months, and that will really determine the size, the desirable size of our balance sheet, which is always a factor of also the circumstances and the situation we are in. But that is coming.
Is it going smoother than you thought it would as well, Chair Powell, QT?
Say it's working as we had hoped and expected it would work. We have a entirely passive program as treasuries and mortgage-backed securities mature. They roll off subject to a cap, and it's been moving along at a pace. The underlying pace, if you hit the cap, is about $1 trillion a year. And reserves appear to be quite ample, so it has a ways to go.
Is there anything that would make you speed that up or slow that down?
We always say that we're prepared to adjust in light of evolving conditions, but I don't see anything that would cause us to want to do that right now.
Okay, so in the moments that we have left, we've talked about a lot of the risks. We've talked a lot about some of the concerns out there. I want to hear some optimism, maybe, and what makes you feel. I mean, none of you are really talking doom and gloom on recession, but what makes you, President Lagarde, optimistic right now?
In my professional field?
However you want to interpret the question. Personally.
Otherwise, there are lots of things that make me happy, and I hope for all of you. I'll just mention one success, which I'm really proud of, and I'm very proud that Fabio Panetta was the one who led that exercise on behalf of the entire group. Today, the European Commission has published the legislative draft for the European digital, for the digital euro, for our CBDC. And that gives me hope because I think that it really demonstrates the capacity to innovate, the capacity to work as a team, the capacity to anticipate what digital payments will be tomorrow. Now, some people are very skeptical and they say, well, you're taking risk, financial stability, possible runs that will be accelerated by this. And all I would say is, number one, you have to be ready. You want to keep the sovereignty of your currency. So many years ago, who would have thought about all the users and the applications that you have on your cell phone? None of us. So being prepared, being ready, paying attention to what actually Europeans and particularly young Europeans want in terms of currency and form of currency is something that we have been doing, that we have accelerated, that we have not decided for sure, but at least the legislative piece is on the table. There will be a lot of discussion. And that's in a way also the result, one of the good benefits of COVID. We have talked about the downside of COVID and the consequences, but the way in which so many of us have become more digital, better equipped, probably more productive. It will be demonstrated probably with a lag time. But when I look at my member states, the countries that were least digital have really traveled very fast to become much more digital. So that's a good reason to hope. And the resilience demonstrated, but I have mentioned that earlier on, by everybody, from the individuals to the entrepreneur to the corporates to governments. We, in Europe, decided to get together to borrow jointly, despite the fact that it's laborious, that it's painful, that it gives a lot of things to report about to a journalist, is also a sign of progress.
And just to be clear, a digital euro will happen when?
That will be decided by the governors in Governing Council. We will decide that at the end of October. And then there will be another phase of piloting, experimenting, fine-tuning, because if and when we go, as will be decided by the Governing Council at large, we want to get it right. So we're not going to do a half start or a fake start. We will move with success.
What makes you optimistic, Governor Bailey?
Well, actually, I'm going to build on Christine's theme, because as well as we're also working on retail digital euro, we're actually also working on wholesale digital money and completely rebuilding our wholesale payment and settlement system in the Bank of England to enable what could be a complete revolution in the infrastructure of financial markets and trade finance. And this is very exciting. So we put the wiring in the weekend before last. The engine should go in next year, and this has enormous potential to change the world at the wholesale level as well.
It's interesting, I feel like the world has moved on to AI beyond digital payments. Are you guys incorporating AI into your thinking about economies and your toolboxes?
I think we're all on a learning curve. I don't know, I feel quite old when it gets to this, but yes, I mean, we're looking at it in two respects, certainly. One is, three respects. One is how it will affect the economy. Two, how we can use it ourselves, both in our sort of, analytical functions, but also actually in our operational functions. We're looking at it, I would say, with very open eyes. You can see the strengths and you can see the current weaknesses of it. And of course, it moves very rapidly. So yes, we're having to, certainly I can speak for ourselves, we're having to devote quite a bit of time now to what the potential is for that.
Chair Powell, is AI one of the things that makes you optimistic?
So on AI, we're just doing what everyone else is doing. We're trying to get smart about it, and it's obviously has huge possibilities. Technologies tend to propagate through the economy fairly slowly, and this one may be the exception, maybe not, I don't know. But it's something that we're spending a lot of time on, way too early for conclusions. I wouldn't use optimism, but I would say this in answer to your first question, which is when inflation first arrives, it's really due to very strong demand for goods and goods pipelines that just aren't working, and shortages. So that's where it comes from. It wasn't about the labor market at all, right? Or very much. As we get to this stage and to looking forward, we think it will be significantly about getting the labor market supply and demand back in alignment. I would say it's a positive thing. I'll say it that way. It's a constructive thing that we've been able to raise rates 500 basis points with the expectation of going further. And we still have a very strong labor market, but nonetheless one that is in fact cooling in just the way we would have hoped, which is to say through things like lower job openings. Job openings are coming down. The quits level has returned to its pre-pandemic level. Wages have, if you look at employment compensation index or average hourly earnings, they've moved down about 1% towards more, still very high, but towards more, so a more sustainable level that's consistent with 2% inflation. So I would just say that's the makings of, if that process continues in a gradual way without really any effect on employment, the longer that goes on, the better. And in a way, I take that as a very constructive path. It is not guaranteed, but the fact that this is really there, and that's what's been happening for a year, well, more than a year into our tightening cycle, I would take as a positive thing and perhaps a hopeful one for the future.
Just be careful not to overdo it, right?
Right.
What about you, Governor Ueda?
Let's see. As other central banks are thinking of issuing digital monies, we are taking a different route, and we have decided to issue new currency bills starting next year.
You're going all in paper.
This will cheer up public's confidence in the BOJ. more seriously, as I said, wages have started to rise at 2% or so for the first time in 3 decades. More importantly, we are seeing
All right. Now, I wanted to end it there because that's all that guy needed to say. Did you hear how he said, we're not going for a digital currency? Japan is this close to moving over with China and the BRICS. See, Japan is iffy right now, and everyone knows it. They don't know who's going to win this. And they're not sure that the American system is actually going to win. They're not sure at all. And that, my friends, is what has them worried, right? It's so, shall we say, up in the air because the globalists, right, are not in a structure of power. They're losing in Ukraine. Russia is kicking the shit out of Ukraine. NATO is in deep trouble. The global banking system, the Western global banking system, is this close to going bye-bye because the BRICS, once the BRICS officially launch the gold-backed currency, that's gonna set a new price for gold. And they know it. And the U.S. knows that it's going to be a war against the gold and the Bitcoin. And it's going to be one hell of a war. Now, there's a few other things I want to show you before our special guest gets here. Let me share another screen. All right, now, If you guys have not gone to see this movie, I'm going to try and see it this week. This movie is causing ripples. All right. I won't even use ripples. It's causing an earthquake out here. Listen to this. All right, hang on 1 second. Let me adjust the sound here real quick. All right, here we go.
These biolabs, I think this is part of the whole business.
What do they do with them in the biolabs when they receive them?
Well, either making the adrenochrome or they're using it to, from what I was told, is that, and also for making agents to, kill people with it. So, if I'm a half Irish, half Swiss, they can get my DNA code and create a cocktail and put it off in an airplane. And I'm the only one that dies of a heart attack in the plane. And then you watch a James Bond movie, you go, boy, that's really weird. So.
Wow.
I'm telling you, folks, things are getting weird. The amount of truth that is coming out right now is unbelievable. All right, we have our special guest here, and let me actually do a word from our sponsor, which is CALIX Solutions. And if you order a laptop, either the crypto laptop or the Liberty laptop, Randy, Miss Teen Crypto, will receive an amount of money from each one of them that calls and uses the name Randy when you order your laptop. So, needless to say, without further delay, here is Randy, Miss Teen Crypto.
Hello, how's it going, Ben?
Hello, beautiful. How are you?
I'm chilling. How are you? I'm happy to be here.
I'm doing great. Thank you for joining us. I've actually been live for almost 2 hours now.
Oh.
Well, there's so much freaking going on right now that every show gets longer and longer because more and more is going on.
I feel the same way.
And we just watched an hour and a half interview of all of the central bank heads of like Bank of Japan, the Federal Reserve, the European Union, central bank, all of them. And they are physically, you can see them. They're nervous.
Oh yeah, absolutely. Absolutely. Why wouldn't they be?
Yeah, and I just want to pick your brain. And by the way, who's the first person in crypto who ever told you you'd be famous?
It was you. It was you. You were really one of like my first supporters, 100%. And I appreciate you so much. I tell you all the time. And I was also telling the Zesty fam about it on my YouTube channel this morning. I mean, I will never forget October 30th, 2020. It was a beautiful day. First meetup. You invited me. I brought you cookies. We all shared love and positivity. And like, it was just a really good day. And I'll never forget that. So yeah, I'm very happy about it. I'm very happy about where we are now too, because it's just been a crazy ride. And I can't believe, like, I was 17 there and now I'm 20, almost 21. So it's just like time flies. It's incredible.
I am so proud of you. I've seen you on, I think, Fox News like 2 or 3 times.
Yep.
And I think you were on CNBC.
Not yet. Not yet. One day. One day. Not yet. I'm working on it.
We'll get you there. All right. Now, I want to pick your brain on what do you see out there, because you're out with the general public all the time.
Yeah.
You absorb crypto news like I do. You're always like just eating it up. What has you most excited, and what has you most worried about the global economy in general?
What has me worried, of course, is the money printing, right? Because all of these central bankers, especially like the Bank for International Settlements, you look at them, they're like private little live streams that like I've gotten access to that are literally unlisted on YouTube, meaning like the only people that can watch the stream are the people that have the link, which is of course like an exclusive group. So, I was lucky enough to like get one of these links sent to me, and I was watching, I even had it on my show this morning where I was playing the clip, because these are a lot of like unelected bureaucrats that are making decisions for all of us. And then, they turn on the money printer, and, who pays the consequence? It's the everyday person. It's not the billionaires or the central bankers. They talk about like the richest people in the world, but that's just like who are the richest public figures. It's not the richest people. The richest people are the people that have like control over the money. And I think that's very obvious. And I think that's why they're physically, like you were saying, scared of Bitcoin, because why wouldn't you be scared of something decentralized, something where there are cross-border payments that are instant, peer-to-peer, something without an intermediary in charge of it, something where people actually own something? Yeah, that's scary because they have the objective. You own nothing and you're happy.
Yeah, it's Pete, and I've always said this. Everyone's like, oh, they're in it for the money. They're in it for the money. These are the people that print the money.
Yeah, they're in control of it all.
Right. If it was about the money, that doesn't make any sense. If you actually produce the donuts, you're not worried about having enough friggin' donuts. You make the donuts. You're the donut maker. It's all about the control of
Absolutely.
the populace. And with cryptos and blockchain, decentralized cryptos and decentralized blockchain. It's the choice of the people is ripping the control out of their hands. And that's why they're actually going after, Coinbase, Kraken, all of these exchanges. But at the same time, you got BlackRock out there because we all know they're going to get it.
Yeah.
I think that with everything going on, they know their system can't compete. So now they're trying to get into the new system while they're trying to frighten retail out of it.
Yeah.
Your thoughts?
Yeah, I do think, of course, I agree with you. Of course, they want to scare retail, right? Because BlackRock, you could look at, they're investing in MicroStrategy. So they have like many kind of like circuits. And if you look at if you look at BlackRock, they pretty much own everything. So it's just like, what don't they have their hands in, right? So, a lot of people are waiting for BlackRock's approval for many things. And of course, for a TradFi like person, they're like, oh, if BlackRock's investing in something or they're interested in something, then whoopee. But you even like look at the Fox interview with Liz Clayman and Larry Fink, the CEO of BlackRock, and he's talking about how, with Bitcoin, though he said he's not personally invested, who knows? But
right.
Yeah, so we don't really have proof of that, but we could always speculate on it. But he's like, although he's not directly invested in Bitcoin, he does see the potential of people owning something, of not having an intermediary. So when you think about it, it's smart for BlackRock. Why would you want an old system where you're transferring money and it's not efficient, it's not fast, and it's actually costly and time consuming? So why don't you just get involved in Bitcoin where there are no intermediaries and it's peer-to-peer, so that way your bottom line is cheaper anyway and you end up saving money. So, but that doesn't mean they don't have their hands in like CBDCs and other payment companies, because they have their hands in everything. So they could tout Bitcoin all they want, but it's also like you have to look behind the scenes. What are they really investing in? What are their real goals for the populace? Because again, they own so many things, it does kind of control every industry. So it's really it's a deep, dark rabbit hole, Ben. But yeah, I think for a normie, this interview was great. Go BlackRock. But they're already telling us stuff we know, that Bitcoin does revolutionize the traditional the financial system in general, where you just take out the banks, you take out the intermediaries that all have the same objective, which is holding your money and not giving it to you when you want it, and controlling how you spend your money. Because even if you look at people now, they try to interact bank account to bank account. They can't send their money, or they're trying to buy crypto. You look at Santander UK, you look at all these like even MasterCard and all these other places, they're limiting how much crypto you could buy, or if you could buy crypto at all. So, the traditional financial system already is super controlling. So again, Bitcoin answer. And BlackRock already clarified that for us. And I do think that hopefully that encourages more people to get involved in Bitcoin, and the ETFs are just going to help people get more exposure. Because what I found interesting is I was talking to a hedge fund manager, and they said that they control how much you could invest in certain things. So they could tell you how much actual Bitcoin you could buy. So then they have to go and get other exposure to the space like ETF. So I think it could help the hedge funds in a way as well.
Oh, absolutely. And this is where Michael Saylor has been a rock star.
Yeah.
Is what so many of these corporations are realizing is if they get involved with the Bitcoin now and it goes on. I just read earlier, and I actually called a friend up in New York just to verify that what I read was right. And there are hedge funds, insurance companies that are well underwater. They're in deep trouble. But according to their calculations, if they front run the next year and a half worth of growth using Bitcoin, that they could use the profits off of that, and it would actually save their friggin' companies. And that's what they're realizing is, wait a second, this is a global sponge of economic energy.
Oh, yeah.
If we get ahead of it, as it grows at historical rates, even just normal historical rates, that their balance sheets at the end of a year and a half are in the black again. And that's what these people are waking up to, that the corporate savior is the same as the individual savior, which is Bitcoin.
Yeah, I mean, yeah, if you look at the banks in general, they're in deep, deep water. I mean, our traditional financial system is so, I guess, fragile, as I could maybe put it. Thanks, other miner. Appreciate that. The 99-cent super chat. I do think that the banks, they're like, okay, we're in trouble. We need another way out. Because if you look at SVB, right? When SVB collapsed, if they didn't save SVB, that actually caused ripple effects throughout the world. So you had Credit Suisse, UBS, like a bunch of things going on internationally. So it just shows that not only is the traditional financial system very like fragile in the US, but it's a global ripple effect because all the banks are connected. The central banks are connected. I like to like compare it to Walmart. Like, you know how Walmart varies like in the north and the south. Maybe in the south you could buy a little, crazy firecrackers or maybe something in the south, but in like somewhere in New York you can't buy anything. It's like pretty plain, Same thing for the central banks. Like, they're in different locations, but they all pretty much do the same thing. They're just a little bit different on how they feel about certain topics, right? But the overall goal is the same, which is to sell everything to the masses, right? And I think that's very interesting. But if you look at SVB, that was a ripple effect that took over the entire world. The whole banking system was like under stress. What do we do? Which bank is getting acquired by here? What are the real balance sheets? Who's over leveraged here or there? And then Janet Yellen was like, everything's okay. Let's bail out SVB, when she said originally she wasn't going to do it. Then everything was fine. Band-Aid put on, scratch covered. Then all of a sudden, First Republic started having issues. Oh, sheesh, First Republic halted 9 times in one day. The stock literally went to zero because it got acquired by JP Morgan. The biggest bank got bigger. So it just shows you nothing is stable. On top of that, there was a study that came out. 722 banks lost over 50% of their capital within the first quarter of this year. We're over 6 months into the new year. We haven't heard any stats on that. And that's the lack of transparency that's in the traditional financial system. So now people are like, hey, what's our way out? What's something where we could hedge against inflation? We could hedge against bank runs. Bitcoin. So now what are we seeing now? ETFs. We're seeing all these banks now investing in Bitcoin, all these payment rails now working with Bitcoin and blockchain and for interoperability. MasterCard, what they're doing now, we want interoperability between blockchains. That's what we're missing here. We want to give people the trust, the foundation, which inevitably leads to their mission for CBDCs, but that's a whole other rabbit hole. But yeah, I definitely think that Bitcoin is the savior. And I do think that they're starting to realize that they need another way to be involved in a financial ecosystem, period, that could give them some sort of lifeline and longevity. We know money's going digital. Inevitably, it should be something we own and something that has staying power. And even like Larry Fink said, Bitcoin is an international asset. So anyone, any bank, anywhere could really get involved in this asset. And it's not really some murky water, right? Because it's all transparent.
Yeah, and although I do believe that a lot of the leaders of our global monetary system are absolutely control freaks, I think a lot of these corporations are now just looking for a way out, some solution. And they're realizing that the Federal Reserve, the ECB, the Bank of Japan, they don't have it. They don't have it's and these central banks, they think everyone, oh, well, they just want quicker, transactions. No, it's the manipulation we don't want.
Exactly. At the end of the day, there is manipulation everywhere. Even again, you look at SVB, right? Why wasn't that watched by all these regulatory people that are sending out, like the SEC? They sent out investor alerts earlier this year. They're like, watch out for crypto. It's too volatile. Then all of a sudden, the bank stocks are down 90+%, and some literally went to zero, like we discussed. They didn't watch over SVB, where like 2 years before, there was a total of like $80+ million that was cashed out by executives, and around 2 to 3 million that was cashed out a few weeks before the collapse. On top of that, there were international entities that got money before people did, right? So SVB, it collapsed. There were people waiting outside for their money because they were like, what's happening here? Then you had Israel, their biggest banks cashed out over $1 billion right before the collapse. So they obviously knew something we didn't, which again is manipulation. And it's not fair that people every day, they kind of like the news kind of made it out to seem like, and that really frustrated me, that there were only rich people that were caught up in SVB, that there's just millionaires that just like don't have their money for 2 days. No. Those were payroll that was going to everyday people. So there were videos of people waiting out there like it was Black Friday at Best Buy with their lounge chairs trying to get their money out of the bank. Then it comes to the point where you're waiting out there for hours. You finally get in the door. How much money could they actually give you? Then at that point, if no one has their money anymore, where are you putting that cash that you have under your mattress? You're posing a physical threat to yourself. So the only way you could really hedge against bank runs, hedge against inflation, and hedge against like actual danger, physical danger, is Bitcoin. Because someone could come in your house and it's like, where is it? They can't get it. So I don't know. Maybe I'm crazy. I don't know.
No. And to your point, this weekend, I was out at the Lake of the Ozarks.
Yeah.
And me and a friend of mine were out fishing. Well, the guy driving our boat had money in, I think it was Silverbank.
Yes. Yes.
And he's just a regular guy. And he flipped out. He was like, whoa, what the hell?
I think he's Flagstar now, right?
I think so, yeah.
Yeah, I saw it in my neighborhood. It's really freaky. It's really weird. I don't like that.
And that's what they do. They just swap it out for a different name. Good enough. It's all a sham because the whole system, they say the strength of the system is the ability to manipulate it.
Yeah, I mean, that's because they have the money, so they have the power to manipulate everything. But that's why they're scared of Bitcoin, because if we have the money, we have the power, and we could make the change we want to see.
Bingo. And they think that, causing inflation, only 2% a year, which means you lose all of your money in like 14 years. It's that manipulation is a good thing. Well, how about we lose 0 of our money? How's that sound?
That would be great.
That sounds great. Well, that's the difference between the central bank structure, where they don't value your overall purchasing power. The cryptocurrency people, that's our whole goal, is is not only save your purchasing power, but grow it. And that's what Bitcoin does. That's why I've said, whether you're conservative, liberal, communist, whatever, that's why I know flat out communists who love Bitcoin, because it literally is the whole network accumulating value as we grow. That's like the communistic dream. And
it fits every hand.
Right. And it's the conservatives love it, like myself, because it is an honest representation of our labor. And if you look at Bitcoin, this is the key to everything. It aligns with nature. Bitcoin is a value added system. That's what nature is value added system. As you plant a seed, it absorbs energy from the earth. It grows. A seed is worth a nickel. A small tree is worth $1. A larger tree is worth $5. A huge tree is worth $1,000. What's the difference except the accumulation of natural energy?
I love that.
Time.
I love that.
That is why Bitcoin is going to win, because if the central bank economy is the complete opposite of nature. You cannot print up more seeds. It has to be from something growing in order to grow. Nothing that is dead will grow.
I agree.
So they print up useless dollars and claim that it's a seed, while Bitcoin uses energy through the mining, which has a cost, which is energy. It's all nature. Energy feeds energy, adds value. While the central banks, it's all an illusion of value. That's why the central banks are dying. That's why Bitcoin's growing, because it aligns with nature.
You know, and that's actually really funny that you say that, because in the economic report of the president, I was reading, I showed it on my show too, and it was just saying, like, they said the definition of money is value, or money that's issued by a sovereign country, and that value is given by the central bank. Like, what is the value of the central bank? How is that value? When they say, what is the value of Bitcoin, when that's energy, that's time and energy put into the asset, which then is given which then gives the people that are putting energy into it a reward. And then that reward, which is the Bitcoin, obviously, is spread throughout the world. It's peer to peer, and again, like, with people. And I think that's, again, like, goes with nature, is like the word of mouth, and, like, you know, people interacting with people directly instead of all these intermediaries. I don't think we were supposed to have intermediaries with a lot of things, you know. like with food, like getting your food right out of the ground. Now, like we have intermediaries for everything. Now in New York, if like the truckers stop trucking, then we only got 3 days of food in the city. Like, what do we do now? But at least with Bitcoin, right? Like maybe we could have access to money so we could buy more food. But it's actually insane. And I don't think it's human nature, like you said, to have all these intermediaries. And that's why Bitcoin just aligns with so many people, especially with owning something and like, literally printing new money out of thin air, which is what the central banks do. And I was even like showing the Zesty fam about Project Hamilton. I don't know if you know about Project Hamilton.
Oh,
You do, right?
yeah.
Yeah. So if you look in the framework for that, they're like, okay, who's the transaction processor? The central banks. And how does it work? Well, if I send you $20 and you in CBDC, then it basically erases my $20 and like deletes it and issues you 20 new dollars. So how does that even make sense? It's literally like monopoly money. And it's so funny, Monopoly came out like with like the digital card version of it, and it's just like it's all ironic how it all plays into things now, but literally monopoly money. And probably even worse than that, because when you run out of like that one pack of money, you got to go out to the store and get another one. So it's a little bit more inconvenient than just pressing a button and making the virtual money printer go burr. But it's like actually insane.
It's what they do is they argue that what gives the central bank value and gives the money, quote unquote money, they produce value is the full faith and credit of the government.
Yeah.
Well, what is that? That's the ability for the government to tax. That's all it is. Without taxation, the government doesn't produce value at all. It's a ledger system for the value produced by the citizens. And then they print up dollars, hyperinflate away all of our labor value that is stolen from the taxes.
Yep.
It's so corrupt that anyone who looks at it for maybe 10 minutes goes, all right, this is crap. All right. But introducing them to Bitcoin, they're like, oh, it's so volatile. No. If you look at the price of Bitcoin, what that is it's showing you a chart of the volatility of the lies of the central bank losing credit. It's because whenever the price of Bitcoin rises, it's more people realizing the Federal Reserve notes are lies. They don't hold the value.
Yeah.
And people, when they actually purchase the Bitcoin with the fiat, they value the Bitcoin more than the fiat. That's what you're doing. You're selling your dollars and you are buying the Bitcoin. And that chart that we see going up, if you flip it, that's the level that the people are actually finding this less valuable. And and now we've reached a point where the slippery slope of fiat credibility is falling off a cliff. And that's why the Federal Reserve has to print money on one side of the building and then retract it out of certain areas of the economy to try and wrangle in inflation. So they're printing and they're absorbing at the same time. That's
having their cake and eat it too.
right. That's called drowning. Right?
Yeah.
When you're moving, but you're sinking, you're drowning. And that's what the Federal Reserve and the rest of these are doing. That's why the video that we've been watching for the last hour and a half, it is so comical because now they're at the point where they're full underwater. There's no hope of getting their heads above the water. Now they're trying to grab onto anything. They don't care if they got to grab Bitcoin and let Bitcoin save them. They don't care if they have to grab Ethereum and let Ethereum save them. Something needs to save them. And they know it's not anything that can come from them. They're CBDCs. They're drowning and they can't pull something out of their pocket that's going to keep them afloat because it's already in their pocket.
Yep. I mean, if you even look at the Bitcoin chart, like you were saying, and you look at like people's reaction to things, if you look at Signature, when Signature Bank went down, Bitcoin like went up, and I'm like, you see all these bank stocks starting to collapse, and Bitcoin's still going up, and it's up over like 80% for the new year, I think. So it's just like, how do you compare, like, you know, Bitcoin to even like any part of the market, or like, you know, it's honestly, it's funny to me how people are like, oh, you know, Bitcoin, I don't really believe in it, it's too volatile, this and that. But how are people hedging against everything that's going on right now? And even if you look at other countries as well, where people aren't banked, or they're receiving their payments on, let's say, their paycheck on Friday, and they have to spend it by Monday because inflation's so bad. So, you know, Bitcoin is really saving a lot of people. And like you said, it's literally people exiting and saying, hey, I'm opting out of a system where I'm controlled, out of a system where I don't get to choose when the money printer goes burr, when I lose my value. Because you look at 2020 to 2021, over 40% of our money supply was printed during that time. That's like decades and decades worth of wealth in just a few months. And of course, you know, someone's going to have to pay the price for that at some point, which we are. You know, you got $10 eggs at the supermarket now. So, you know, there's a lot of people that are saying, hey, my purchasing power is going down, my ability to make change in my own life is going down. So how can I fix that? How can I actually make sure I own that? And that's where, again, like Bitcoin comes in, especially if you look at the stock market. It's a totally controlled game. You know, no one gets to win except for the big boys there. So
yeah, you're absolutely right. Well, young lady, I'll tell you what, I don't want to keep you too long. Plus, I have right now I'm up in St. Louis at my office, but I gotta head out and go back down to Florida. The struggle's real.
I'm jealous. I want to go check out your new place, Ben. We got to talk after this.
Oh, hon, you let me know when you want to come down to Florida. You and the old man, you crash at our house. We got a pool. We got a hot tub. We'd hang out, hit the club. You'll love it. You'll love it. It's such a great
awesome
energy there. All right, everyone out in the chat, please give Randy a thumbs up. And where can they find you?
You can find me on missteencrypto.com, has all of my socials. I'm at Miss Teen Crypto everywhere, Instagram, Threads, you got Twitter, Rumble, Kick, YouTube, Twitter. I'm always there. And at Randy Hipper on Facebook. I'm always live on Monday through Thursday, 9:30 a.m. Eastern for the Daily Zest. And I also have the Miss Teen Crypto Show where I interview some awesome people. Ben was one of my first shows. And then I also have had Michael Saylor on recently if you guys want to go check that one out. And I also have Thank you. I also have educational content. If you guys have a teenager in your life or any newbie in your life, send them over to my channel. I have 1 to 2 minute intro to crypto videos. They're posting on TikTok, Instagram, YouTube, Twitter, everywhere. So everywhere you can find me, you can find these videos. And all we're out here to do on this channel is to spread adoption, help the next generation and beyond come into crypto and educate them about self-custody, freedom, and positivity. And thank you, Ben, for supporting me literally since day one. I will never forget you. I talk about you on my show often too. So I appreciate you so much, and hugs to you and Kelly and the family.
Hey, the moment I met you and your energy, and you were like, I want to learn more. I'm like, this gal's going to be a superstar. And you've only yet begun, young lady. You will keep on kicking ass. All right, well, you tell your dad I said hi.
Will do.
And have a great day. Everyone else, I will see you tomorrow morning, usual time. Randy, have a great day.
You too. Much love, guys. Peace.
Bye-bye.